name is Chong metric number 298617. Today, I would like to present about the study on DONGFENG Motor Corporation, focusing on its performance and internal and external factors that influence it. This research primarily uses return on equity, which is ROE, as an indicator of performance. DONGFENG Motor was founded in 1969 in Wuhan, China, initially producing military vehicles. Over time, it expanded into commercial and passenger vehicles and formed key joint ventures with companies like Nissan, Honda, and Stellantis. In Malaysia, DONGFENG entered the market through DONGFENG Commercial Vehicles Malaysia Sdn Bhd and recently launches its electric vehicles, the DONGFENG Box, in 2024, highlighting its shift towards sustainable mobility. There are several issues impacting DONGFENG performance. As a state-owned enterprise, policy objectives often take priority over profitability. Financial transparency has been a concern, and recurring vehicles recalls have raised doubts about its quality control. This factor challenge its credibility and competitive position in Malaysia's market. From this, we developed the following research objective. First one is to determine the internal factors that affect the performance of DONGFENG Motor in Malaysia. Second, to determine the external factor that affect the performance of DONGFENG Motor in Malaysia. And the third one is to evaluate the combined effect of internal and external factor on the performance of DONGFENG Motor in Malaysia. This translates into our research questions such as, do internal factor affect the performance of DONGFENG Motor in Malaysia? Second one is, do external factor affect the performance of DONGFENG Motor in Malaysia? And the third one is, do internal and external factors collectively influence the performance of DONGFENG Motor in Malaysia? The topic was derived from reviewing prior studies that highlight the importance of financial risk in determining firm performance. One key factor is liquidity risk, as highlighted by Fabosi and Peterson, which refer to the risk a company faces when it cannot meet its short-term obligation due to an inability to convert assets into cash quickly or at an acceptable value. This is typically measured using ratio like the current and quick ratio. A company with poor liquidity can face several consequences, including insolvency. Next is credit risk. As defined by BWRRK, is another critical factor. The risk arises when a borrower fails to repay their debts, impacting a company's financial stability. In our context, we will examine indicators such as the debt-to-income and debt-to-equity ratio, which help assess how much credit risk the company carries. Additionally, operational risk, described by Basel Committee, involves the potential for loss due to failed internal processes, human errors, system failure, or even external events such as natural disaster. This is a major concern for companies including DONGFENG, as it can disrupt business operation and damage reputation. Finally is market risk. Market risk stems from fluctuation in market variables like interest rates, foreign exchanges, and commodity price. Jorian explained that firm exposed to these changes can experience significant financial loss, especially those that operate in international markets. Our sample includes DONGFENG Motor annual data from 2014 to 2023. The analysis was conducted using ordinary least square (OLS) regression through SPSS software. We developed three models, which is Model 1 focuses on internal factors like debt-to-income, current ratio, and average collection period. Model 2 examines external factors such as unemployment rates, interest rate, and exchange rate. Model 3 combines both internal and external variables to evaluate their joint impact on ROE. Let's begin by reviewing the descriptive statistics for Model 3, which combine both internal and external factors to examine their impact on ROE. The ROE for DONGFENG Motor during the study period was around 1.06, which suggests that while Dongfeng profitability has been stable, the returns are modest. The company has been able to consistently generate profit from its equity, but this profit has not shown significant growth over the year. Next, we look at return on assets, which is ROA, which averaged 0.061. This figure indicates that Dongfeng has been fairly efficient in utilizing its assets to generate profit. While this is a relatively low ROA, it does reflect an efficient use of resources for the scale of its operation. The current ratio, which measures the ability of a company to meet its short-term obligation, averaged 1.02. This is an indicator that Dongfeng has been in a generally good position to cover its current liabilities, even though it's just above the ideal benchmark of 1. However, the debt-to-income ratio averaged 1.61, which is quite high and raised concern about the company's credit risk. A higher debt burden can limit Dongfeng's ability to take on new debt or invest in growth opportunities due to higher interest payment. This is an area that will need improvements in the future to ensure more financial flexibility. On the external factor side, inflation averaged 1.76%, interest rate averaged 4.23%, and GDP growth was 5.93%. These figures suggest a relatively stable economic environment for Dongfeng during the period under review. These external factors have shown moderate fluctuation, but they have remained relatively stable, contributing to a more predictable operating environment for the company. From the correlation analysis of the variable, we observe a very strong and statistically significant correlation between ROE and ROA. This indicates that higher asset efficiency is directly driving higher equity return for Dongfeng Motor. This result suggests that improving the efficiency with which Dongfeng utilized its assets could significantly boost its ROE, which is consistent with findings from the past studies, like those by Johnson and Lee, who found that better assets utilization has a direct impact on the firm profitability. On the other hand, unemployment shows an insignificant correlation with ROE. This suggests that within the period we study, changes in the unemployment rate had a little to no direct impact on the Dongfeng's profitability. While it's possible that external factors like unemployment could influence other aspects of the business, it doesn't appear to significantly affect ROE in this case. Now, let's look at the model summary for the 3 model. Model 3, which combines both internal and external factors, has the higher adjusted R-square of 0.9. This suggests that Model 3 is the most powerful model in explaining ROE compared to Model 1 and Model 2, which has lower adjusted R-square value of 0.741 and 0.696, respectively. The high adjusted R-square value for Model 3 indicates that the combined influence of both internal and external factors provide the most robust explanation for the variation in Dongfeng's ROE. This also supports the idea that a comprehensive approach, one that considers both the company's financial health and the broader economic environment, is the best way to understand and predict Dongfeng's financial performance. Next is the ANOVA test, which helps us assess whether the model we have built are statistically significant in explaining the variance in ROE. For Model 3, which includes both internal and external variables, the p-value was 0.228, which is greater than the 0.05. This means that while Model 3 explains a substantial amount of variance in ROE, it is not statistically significant at the 5% level. This result suggests that there may be other factors that influence ROE and are contributing to the unexplained variance. Despite the lack of statistical significance at the 5% level. The high adjusted R-square value of 0.9 indicates that the model does a good job of explaining the variation in ROE. The model's ability to account for 90% of the variance in ROE is still notable, especially given the complexity of the factors involved. Finally is regression coefficient, for each model to assess which factor have the most significant impact on Dongfeng's ROE. In Model 1, which focuses on internal factors, we found that the debt-to-income ratio had a significant negative impact on ROE. This suggests that as Dongfeng's debt burden increases, its profitability decreases. This result aligned with past research by Smith, which found that higher debt burden can reduce profitability due to increased interest costs and financial strain. In Model 3, which includes both internal and external factors, the average collection period had a significant negative effect on ROE, meaning that longer collection time hurt equity returns. A longer collection period can be detrimental as it ties up resources and increase the risk of bad debts. Improving receivable management could lead to better cash flow and improved profitability for Dongfeng. From the external factor in Model 2, we found that inflation and interest rate had a moderate impact on ROE, though their effects were not as strong as internal factor. The interest rate had a positive effect, suggesting that higher interest rate could potentially increase ROE, although the relationship was not significant. The inflation rate had a small positive influence but was not statistically significant. The finding from Model 3 shows that while internal factors like debt ratio and asset utilization are more influential on ROE, external factors like inflation and interest rates still play a role, even though it is less significant. Overall, improving internal financial management, especially in terms of managing debt and collection times, appear to have the most substantial impact on Dongfeng's performance. To conclude, internal factors like ROA and debt ratio have a stronger influence on Dongfeng's ROE than external factors. However, all variables together offer the best explanatory power. The recommendations for Dongfeng model are improve liquidity through better working capital and cash flow management, reduce financial leverage to lower credit risk, hedging strategies to manage economic volatility, and investing in EVs and sustainability, while aligned with global trends and position Dongfeng for long-term competitiveness in Malaysia.